Hey everyone, welcome back to Corporate Decoder, the place where we try to find a silver lining in the stormiest of financial filings. Creative Medical Technology Holdings Incorporated is making some interesting moves with their latest report, and we are going to break it all down for you. Before we dive in, if you appreciate getting straight insights from corporate documents, make sure you are subscribed and maybe consider joining our Discord community linked in the description below. We are doing some really cool discussions over there. So what is the big news? Well, it looks like Creative Medical Technology Holdings Incorporated, or CMHT, has managed to get some existing warrants exercised by offering new ones in return. Think of it like this: they had some folks who held a type of option, a warrant allowing them to buy the company's stock at a set price, instead of just letting those expire or be used as is. The company sweetened the deal. They said, hey, if you use your old warrants now, we'll give you new warrants. This is a pretty common tactic in the financial world, especially for companies that need a quick cash injection. They are essentially encouraging their shareholders to commit more capital with the promise of future upside. The filing states that over 1.1 million shares worth of warrants were exercised thanks to this offer. Now let's get to the numbers, because that is where things get really interesting. The company is bringing in about $4.2 million from these exercises. That is a significant chunk of change, and the company says it is going straight into working capital and general corporate purposes. Think of working capital as the money a business needs to operate day to day, like paying bills and salaries. General corporate purposes is a bit more of a catch, all meaning they can use it for whatever they deem necessary for the business's growth or operation. Now here is a bit of a twist. For this deal to go through, the company had to issue new warrants to these holders. That is nearly 2.8 million new warrants. These new warrants have a starting exercise price of $3.75 per S-hair, but there is a kicker. That price can actually go down. It can be reduced to the lowest average trading price of the company's common stock over a 5-day period after the new warrants are issued. This is known as a variable exercise price. It is designed to protect the warrant holders. If the stock price dips, they are still incentivized to exercise, because their cost to buy the stock goes down too. However, there is a big hurdle for these new warrants. So these new warrants can't be used just yet. The company needs its shareholders to vote and approve them. This is often a requirement when a company issues a large number of new shares or warrants that could significantly dilute existing shareholders. It is a way to ensure that the people who own the company have a say in how it expands or changes its capital structure. On top of all this, they are also reducing the exercise price on some older warrants. This is another move to incentivize holders to exercise those older warrants. Making it cheaper to buy the stock can encourage action from those warrant holders. And who helped them pull this off, a firm called Roth Capital Partners acted as their financial advisor. Now for their services, it looks like Roth is getting paid. They are getting 8% of that $4.2 million, which is a pretty substantial fee. On top of that, the company is also reimbursing Roth for about $40,000 in legal expenses. So while the company is bringing in cash, they are also incurring significant advisory fees. Now let's talk about the implications of all this. The new warrants and the shares that will be issued, if those warrants are exercised, have not been registered with the US Securities and Exchange Commission. This means they are being sold under an exemption from registration. This is common for private placements, but it also means that the securities can't be freely resold in the public market without registration or another exemption. The company has committed to filing a registration statement to allow for the resale of these shares within 30 days of the deal closing. This is crucial so that those who receive these shares can eventually sell them. Looking at this overall, we see a company actively managing its capital structure. They need cash, and they are using financial instruments like warrants to get it. The strategy is to incentivize existing warrant holders to convert their holdings into cash for the company now, by offering them new warrants with potentially attractive terms later. For Creative Medical Technology Holdings Incorporated, this is a tightrope walk. On one hand, bringing in $4.2 million is a positive step and could fund important operations or growth initiatives. On the other hand, issuing a large number of new warrants, particularly with a potentially variable exercise price, can signal to the market that the company might be diluting its existing shareholders in the future. Dilution means that each existing share will represent a smaller percentage of ownership once more shares are issued. A key risk here is that the company may not be able to secure stockholder approval for the new warrants. If that happens, the whole incentive for current warrant holders to exercise might vanish, and the company might not get the cash it anticipates. Also, the variable exercise price on the inducement warrants introduces uncertainty about the future cost of issuing stock. A Warren Buffett lens would look at this and ask, what is the underlying value of the company that justifies this aggressive capital raising? Are these actions fueling sustainable growth, or are they a temporary fix for deeper financial issues? We don't see explicit financial tables here in this particular filing since it is focused on a specific transaction, but we would normally scrutinize revenue growth, cost management, and profitability to answer those questions. In conclusion, Creative Medical Technology Holdings Incorporated is navigating a path that involves leveraging its existing financial instruments to secure capital. The success of this strategy hinges on shareholder approval and the future performance of its stock price. It is a bold move that could pay off, but it also carries inherent risks related to dilution and market perception. Alright, that is our breakdown of this filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.